Right now, I guess we're recording right now. That's great. Um, Introductions. Well, first of all, I'm Gene. And Jonathan, why don't you say hi to everyone?
Hi, everyone.
That's Jonathan Name, my law partner, and he'll be working on conducting this seminar with me. And that's great. Then I want to introduce Derek. Derek Beecher is the staff person. I think you're in charge of the whole Ward Center. That's pretty impressive. And thanks for being with us and making sure we get this running. Thank you, Derek. Carrie Dunn, say hi, Carrie.
Hello.
Carrie Dunn is our one of the members of our firm who helps Jonathan and myself make sure all this works. And so I think we're all set. I think we'll just get on with the material. And okay, so you're all on, and you can see me and you can see Jonathan, and we're going to have quite a few people. Right now we're at 31, and I think we're expecting close to 50 to come on. So we won't be able to have introductions because it would take all of the time. But we're ready to roll. Syndication and crowdfunding workshop. Yes, yes. I know you all have. You can see my screen. So that's good. Let's see if I can move to the next slide. First of all, because we're lawyers, we have to have the infamous disclaimer. And our disclaimer is basically that we're not answering individual legal questions about your offerings. This is an educational event. We're happy to talk to you after this session. You'll all know how to get a hold of Jonathan and myself. And if you have questions about the deals you're working on, or what we call homework questions, when you're thinking about doing something, but you need to know more about it, you can just go to our website and sign up for a free consultation. And we'll be happy to talk to any of you as long as we need to help you understand what you're doing. Because one of the things about this topic is that it takes us away from just being real estate people. You're entering into the world of securities law. And when I wrote my first edition of my book, which was quite a while ago, what I was doing for the Ward Center is writing a book so that real estate people would understand, if they're putting together a group of investors to buy a property, that we're leaving the world of real estate. And I called my book, It's a Whole New Business, because it is a new business. It's a business of the securities laws. So there's a lot of vocabulary going on here. We'll take it slow. You have a copy of the PowerPoints, and you're all going to have a copy of the book. Let's talk about why I'm doing this. So I went too far. I'm the founding partner of Trowbridge Ney, and Jonathan is also a founding partner. One of the important things about me is, while I have been a CCIM for very, very many years, 43 years actually, while I was active in the syndication commercial real estate business, I moved from being a broker into being a syndicator. And we put together 16 syndications where my goal was to buy dirt and get it entitled and build self-storage facilities. So that was the business I was in. And I was raising money through the broker-dealer network. The securities people were raising money for me, which was interesting. And at one year, I found that I had mailed 1,676 K1s out to my investors. And for one reason or another, I thought that was too many. I thought that I had done what I wanted to do in the syndication business. And as a midlife event, I went to law school, and I passed the bar, the California bar, when I was 45 years old. And I've been doing syndication law, securities law ever since then. It's the only law that we do. We do the adjacent real estate law, of course, if our syndication is a real estate venture in California or Texas, we're able to do the real estate work. But that's the work I do. And over the years, we've represented over 625 different sponsors who we think have raised about $6 billion in offerings. We also do, and lately in the last couple of years, our business has expanded where we're helping people do businesses. We've helped someone do a fiber optics business. We've helped people do avocado groves, beauty salon networking, where they've opened a whole series of beauty salons, cannabis farming, which is more than just real estate. So there are all sorts of people who are using us. Actually, this year, Jonathan and I helped a group buy a minor league hockey team in Texas. So a lot of different things that we've done. I was a senior instructor for 40 years at the Institute and author of A Whole New Business. And the picture I have up here is one of my favorite things that I do. I run half marathons, and that picture was taken when I was 60 years old at the end of my very first half marathon. I never had been a runner. I was in Kauai. There was a half marathon that was going to be run starting basically across the street from the condo project that we stay at. And I thought I'd sign up and do that. No training, a lot of blisters, chafing, all sorts of things, but we did it. And since then, in the last 15 years, I've run 40 half marathons. And why that's my favorite picture is I'm carbo loading, which I like to do at the end of the marathon, have a few beers, and that's great what I do. So that's me. Jonathan, introduce yourself.
Thanks, Gene. So I'm Jonathan. I am Gene's co-founding partner here at Trowbridge NIA. My story is a little bit different from Gene's. I didn't go to law school. Later in life, I'm 36 now, turning 37. I went to law school when I was in my 20s, late 20s. Went to both UCLA for undergrad and law school, so double Bruin. And really my first introduction to syndications was during law school. I took a class called Real Estate Financial Analysis. It was basically CI 101 for those that have taken it. So just analyzing a multifamily syndication deal. And I mean, I didn't know it at the time, but those were syndications. The professor essentially, he was a syndicator, and he made us analyze his deals. After law school, I worked for a company called Patch of Land. And for those that don't know them, they are a real estate crowdfunding portal. So essentially they're essentially a hard money lender. So developers go to them for financing. But then the company Patch of Land, they turn around and sell those loans, fractional interest in the loans, to investors online through a 506C offering. So my job there was, a lot of it was related to the security side of it and verifying accredited investors. So when we talk about that on Friday, I could kind of walk you through the process that I had to go through to verify investors. I've been working with Gene for over 7 years now, through many iterations of our firm. And then lastly, I am a CCIM candidate, so I have taken all of the classes. I'm just working on my portfolio now, so, investing myself personally. Unfortunately, I can't use my clients' deals as part of my portfolio since I'm not actually doing the real estate transactional side of the deal. I'm working on the money raising security side. So hopefully one day I do get my PIN. It is kind of a big process to do that portfolio on my own, right? So but that's me.
That's great, Jonathan. Thanks. So our presentation objectives are that we understand the importance of the real estate private placement market. Now, when I said earlier, there's a lot of vocabulary. So a private placement is a placement where you raise money from a group of people to do some business venture. And we don't go to Wall Street. We don't fully register with the Securities and Exchange Commission. It's a whole industry of private placements, big industry. By the time you're through here, you're going to know that being a real estate syndicator deals with the fiduciary duties to the investors, and that being a real estate syndicator involves working within the securities laws. We're going to understand what real estate crowdfunding is and how it might apply to you, and that's a vocabulary decision, crowdfunding. And we're going to, on Friday, talk about some of the mistakes that real estate syndicators make so that you can avoid those. There's no question that you can do syndication. And I imagine that many of you who are on the call are thinking about doing syndication. And many of you maybe already have done syndication. So for those of you who have done syndication, maybe there'll be something new that you'll learn in this course that'll help you do better on your next offering. And those of you who haven't done syndication, which we call rookies, this would be an important 3 hours of your life to learn what's going on. What we're going to do with the questions is we'll put them in the chat room, and today Jonathan is going to manage the chat room and see if we can answer the questions that you present. We've recorded the session. It's going to be archived, and typically the Institute gets that archive ready in a day or two. So today is Wednesday. Probably this session will be ready, be archived by either Friday or Monday. Then we'll record the session on Friday. We're going to cover the material that's in the slide deck. In your material and your course resources, you have been given a set of the slides and a PDF copy of the book. We're not going to do much in detail in the book, but we'll talk about sections of the book that are on your own would be a good idea for you to study. We're on the 4th edition of the book. Generally, the book gets a new edition when the SEC makes new changes. And this last edition we had covered the changes that they made in 2022. Questions, put them in the chat room. We'll either cover them as we move forward or wait till the end of the session, whichever is more appropriate. So here we go. This is how we get started. If you're going to buy a piece of real estate or you're going to start a business, but let's concentrate on real estate. If you're going to buy a piece of real estate yourself, someone has told you that you need to form an LLC and buy the piece of real estate in that LLC. The importance of that is in an LLC, which is a limited liability company, if you follow all the rules and do everything right, the only assets that can be attacked by the outside world are the assets that are in that LLC. So if you buy a property and someone slips and falls and they want to sue, they're going to sue the LLC. And the only thing they can go after is the asset or are the assets inside of the LLC. And that's very important for asset protection. So if you don't ever do a syndication, but you're going to invest yourself in real estate, make sure you're buying properties in an LLC. And then the LLC will take title to the property. The LLC will be the borrower. But you as the member, you'll put your money in an LLC and you'll be the member and you're going to make the cash distributions and you're going to manage it. It's going to be called member managed. Now, right now I'm going to say something. The industry uses terms LP and GP. The industry, it's very common for someone to talk about putting together an LLC and raising money from LPs. That's incorrect. It's not a big deal. but it is incorrect. LPs, limited partners, are in limited partnerships. GPs, general partners, are in limited partnerships or general partnerships. And those two definitions have different rules. So we're going to stick with the words member, and then we're going to get somewhere to where we're going to stick with the word member manager. And that's going to be important because when you read your documents that your securities attorney drafts for you, they're not going to use limited partners and general partners. They're going to use members and managers. So you'll know what they're talking about. So this is the way everyone starts. Now, here's where we move on to what we want to talk about. What if there's more than one investor? Now we're into the world of syndication. Jonathan and I get a lot of calls. We call them homework calls. People want to say, well, I want to put together 10, 15 investors to buy a piece of property, and I don't want it to be a syndication. Well, that's a bad question. That's a question that's bad because we don't understand the vocabulary. A syndication is simply two or more people joining together to do some business venture. When you fly on an airplane, 140 of you buy tickets and you get good equipment and you hire a manager, that's a syndication. We watch television shows and they talk about all the people, all the icons that are at the beginning of the show that worked on putting the show together. Well, that's a syndication. A lot of things we do in life are syndications. So when you call and say, I want to put together a group of investors, it is a syndication. But that's not the question we want to talk about today. Today, we want to talk about, has the syndication grown? Is the syndication going to be structured that? Will the syndication take you into the world of securities? Because one of the problems we have with a member managed LLC is that everyone has a vote. Every decision has to be unanimous. There can be no one in charge. And the votes cannot be determined by the amount of money that an investor makes. If I put in 10% and Jonathan puts in 90%, and we want to do a member managed LLC, if we wanted to do that, there would be two votes and everything would have to be unanimous. Jonathan's 90% doesn't determine what happens to my money. My money is my money, and we have to have a unanimous vote. So it's very difficult to do member managed LLCs as the number of investors grows. Very, very difficult. So we're going to have to understand what's going on in the securities world. And in the securities world, our picture changes. It still is the same with an investment LLC. The investment LLC buys the property, takes title to the property, is the borrower. And all the investors are members. They come in and they purchase interests in the LLC. Well, one of the things you need to understand there is the members are not buying real estate. They're buying an investment in the LLC, which is personal property. We won't talk much about it, but in a more advanced class, we talk about 1031s in syndication. Just know that as a member comes in and invests in an LLC, they're not buying real estate. So it doesn't qualify for a 1031 exchange because you have to go out from real estate into real estate. And when you're an owner, when you're a member in an LLC and you get your money out at the sale, you can't move on to exchange into a piece of real estate because you don't own real estate in the first place. That's a question that Jonathan and I get often about what do we do with someone who has money in an accommodator's account and wants to invest in our LLC. Well, simply the answer is we have to go into the world of tenants in common. And we don't really cover that in this class, but that is the answer. So if you have questions about that, you can call us and ask us about 1031s and how it works in the world of syndication. But the important thing that's changing here is this orange box. Now we have a manager. The manager runs Investment LLC. Many times the manager is a member manager, which means the manager is a member of the LLC. Sometimes, for some reasons, the manager is not a member. It's called a non-member manager. And in either way, what does the manager do? The manager runs everything. He may invest some cash. He or she may receive cash distributions and fees from Investment LLC, but the manager is going to run everything. And so that's a new box. So this picture is a manager managed LLC. There's another box that's there that comes into place sometimes, and Jonathan and I call that the enhancer box. Other people call it sponsor, angel, key principles, whatever it is, but we call it enhancer. It's our own name. And what it is, for example, the LLC needs to borrow $3 million for the loan. The lender says we need to see that the people who are going to sign on the loan have $3 million in net worth, because that's usually the rule of thumb. You have to have bring enough net worth to the table to match the amount of the loan. And who's going to sign on the loan? The members of the manager. Now, the loan may be recourse, it may be non-recourse, that's another issue, but this is who the lender underwrites. The lender underwrites the property up in Investment LLC. They look at comps, they look at NOI, they look at debt coverage ratio. They do all that up there. But when they look at the borrower, they're looking at the people in the manager. And sometimes the group in the management company doesn't have the equity needed. So they may have to reach out to someone, an enhancer, to bring their balance sheet in and agree to sign the loan. Creditworthiness is a reason we have enhancers. Liquidity. Sometimes the lender wants a compensating balance deposit in the bank, especially if you're dealing with local or regional banks. And we need to have someone who can put that money up in a savings account. So we get an enhancer. Property management. Many of you will do syndications that aren't in your backyard. So you're going to have to go to find a property manager in the vicinity, in the locale where the property is, to solve the lender's requirement. And these enhancers may end up having to go into the manager group. They may not. Probably an issue that comes down to what does the lenders want. That's why we have this question mark. Certainly all the things that the enhancers do for us are of value. So there's going to be compensation one way or another going to the enhancers. And that's something we can talk about when we talk to you about the structure of your deal. So the important issue in this picture is that the manager is in place and the manager is going to run everything. And this is called a manager managed LLC. Whether the manager is in the group or a non-member manager, it doesn't make any difference. It's still vocabulary, a member managed. Now, we often get a question, what if we're going to buy more than one property? And so this happens when today someone goes out and they found a seller who has 2 or 3 properties, individual properties, that they'd like to sell all at once, and your group would like to buy all 3 of them. Well, generally what's going to happen is each of those individual properties will be purchased in a separate purchase and sale agreement. We'll have a separate underwriting and a separate loan, and the lender wants them to be owned in their own separate entity, which is called a single purpose entity. So we would form this LLC. This LLC would take title to the property. There can be multiple ones. Currently, there are clients of ours who think that if they raise a lot of money up front in investment LLC, they can go out and maybe buy multiple properties as people are getting in trouble with their current financing situation. And we'd call that a fund. They want to raise money. The LLC wants to do a blind pool where we don't know what the properties are, but they're going to raise money and buy more than one. And that's fine. We just use single purpose entities. And these are for IRS disregarded entities. Generally, they're going to be operated under the same tax ID number that investment LLC forms, and all the income and expense reporting and depreciation goes up to investment LLC, and investment LLC files one income tax return, and each of the members gets one K1, even though there might be multiple properties there. So that's something that we thought we should show you this time. So what is this private placement market that we talked about? This is one of our objectives, to tell you that this is a big deal. Every year, Jonathan and I go to a conference that's driven by the SEC and the state regulators, and they give us experience reports. And the last conference we were at, the most recent numbers, and the new numbers will come out in March of next year, but the last number was the private placement market is $2.7 trillion raised in 12 months. The SEC knows that because every time we do a syndication, we file an information report with the SEC on the syndication. And then they add up all the numbers and say, gee, looks like people are raising 2.7 trillion. Well, that's more money than is raised on Wall Street in new offerings in the same period of time. This is huge business. The private placement industry, according to the SEC when they research it, is where all small businesses operate. You know, you start a business, you get your own money, you get your parents' money, you get some money from the bank, and you're short, and you have to go out and raise some more money from investors. If the business might be buying a shopping center, it might be buying an apartment building, it might be building self-storage. But whatever it is there's a business and there's a need for equity coming from outside investors. And of the 2.7 trillion, the SEC thinks about a third is real estate. So 2/3 is funding businesses. And when they say small businesses, they're talking about businesses where there are less than 500 employees. So we're going to talk about it later, but when the Jobs Act came out in 2012, it was all about jump-starting our businesses, freeing up the formation of capital so more capital can be raised so that we can help provide capital to businesses, to real estate and other businesses. So that's important. And then the SEC says that a certain number of funds state that the amount they will raise is unlimited. So that total amount may be understated. And we do that. Someone might come to us and say, we'd like to start a fund and we'd like to buy at least 2 properties, and we think we'll need $5 million to buy the 2 properties. Okay, good. But, you know, we might attract a number of investors, and we might be able to buy 2 properties, and maybe we want to go to a 3rd property. So we will write the offering documents that would say something like, you know, the maximum raise is 5 million, but the sponsor has as his or her sole authority to increase the maximum to 7.5 million. Well, we don't know if they're going to do that, and the SEC never has us do a secondary report. So hopefully there's more money raised than the $7 trillion. But what's important to you, and the last year that I saw this statistic, I didn't see the statistic in 2022, but the last year I saw it, it said that the median raise was 2 million. So out of the $2.7 trillion, if you took all the offerings and you put the smallest one on the bottom and put the biggest one on top, and then you slice it in half of the offerings of the 2.7 trillion are $2 million or less. So that's something you can do. That there are a lot of people doing small offerings. We have an awful lot of people who do offerings in less than $1 million. We have people who do offerings at 150, 165 million. But there's just a lot of small offerings. And so I don't want you to think that this is huge business, depending upon where you are in the country. You know, if you could raise $1.5 million or $2 million, you could buy a $4 or $5 million property, and that'll let you buy plenty of real estate. So this is something you can do. Now, in this 2.7 trillion, the SEC thinks that 66% is equity. So we're going to buy money, we're going to raise money, and we're going to use it for the down payment. We're going to use it for capital expenditures. We're going to use it for reserves. It's equity. Or a third of the money is raised. Well, we're going to raise money, and we're going to do what Jonathan's old firm, Patch of Land, did. Lend money out. And so you're going to invest in a fund that is a lender, and someone's going to borrow that fund. No equity involved, just interest and getting your money paid back. And we do both kinds of funds in our company. People start a fund and they want to raise money to make bridge loans to developers who need extra money to get their project finished. In fact, one of our most prolific syndicators, that's all they do, is they raise money and then they lend money to the developers. And they take control while they're lending the money, but they don't have any equity. And then when the money's paid back, they give up their control. So that's something we can do. There are a lot of things to know about this business, and I just want to share you that in the book, and you've all received a PDF of the book, there are all sorts of topics that are covered. And these topics are basically the chapters in the book. And we're not going to be able in these 2 days to talk about everything. We're going to talk a little bit about everything, but not in depth. And so this is where you can go and find more information about the book. And I will say that if you're into audibles at Amazon, a Kindle, we do have an Audible. I narrated the book at the beginning of this year if you want an Audible. And if you want a hard copy, you can go to our website. We'll talk about that later. And if you just pay the $9 in shipping, we'll send you a hard copy. But we want everyone to have a PDF copy as part of the curriculum in this course. One of the questions we get is, why would we want to do this, Gene? Is there any way we can make money? Yep, a lot of ways. This is just one slide, and I only could have so many bullet points that you could read, but there are many, many, many ways that you can make money. The common ones that we see is retaining ownership interest for yourself. It's very common that the investors put up all the money, and let's just say that with all the money, they own 80% of the project, and you own 20. That's very common. I'm not saying 80-20 is the only answer. There are many different answers, but yes, that's just an example of how you can take ownership interest. Acquisition fees. One of the things you are going to learn is that we're not going to take real estate brokerage fees when we buy properties for our syndication. That's trouble in the securities industry. But we can take an acquisition fee. Maybe it's kind of the same thing, 6 of one, half a dozen the other. But a typical acquisition fee might be 2 or 3% of the value of the property when you're buying it. That's a way to make money. Asset management fees. Investment LLC needs to be managed. You need to meet with attorneys and accountants and do tax returns and quarterly reports. So there's an asset management fee that's a revenue stream. I don't have property management on here. Most of our syndicators use third-party property management, but it's possible you might, if you have a property management company and you're buying properties locally, this is a property you might manage. Disposition fees. We're not going to take commissions at the sale, but we are going to, in return for the work that we do to get a property sold, we are going to take a disposition fee, whether or not the property is listed by someone else. There could be a third-party brokerage fee, and we take the disposition fee, and typically it's 1% of the value of the property. It doesn't have to be, but that's typical. Shares of operational cash flow. We're going to split the cash flow that comes from operating the property between the members and the manager. That's a source of income. Share of refinancing proceeds. At some point in time, we might have to go out and refinance the property, and that's a job. That's a task that the manager undertakes, and he or she should get paid for their time, and refinance fee, and share of sales proceeds. You know, if we structured this deal 80-20, when the investor is putting up all the money and getting 80%, when the property sells, we'll get 20% of the sales proceeds. Now, on the bottom, I have possible real estate fees for licensees. I don't think that's really workable in the securities worlds, and we would tell you if we were doing your documents that whatever your situation is, if it's something we could make happen. But I will tell you from my own experience, being a syndicator for about 20 years, I didn't do that, and it didn't turn out that being a syndicator was an improvement in my real estate brokerage business. How I improved my real estate brokerage business was taking other courses that taught me how to be a listing agent or a real estate broker, and all the stuff I learned at CCIM, but not from the syndication business. In fact, this probably doesn't work for this audience, but if I were talking to you in my consultation call and you said you were going to be a syndicator and you were thinking about getting a real estate license, I would counsel you in the pluses and minuses of that. There's some good reasons or some bad reasons, but a lot depends upon what you're going to do. Are you going to be a full-time syndicator? Well, then I'd have one answer for you. If you're going to do both syndicate and broker, well, then of course there's a different answer, but we can strategize. And so Jonathan and I have experience in giving you advice on that. What are our clients doing? I thought that that'd be interesting for you to see what we're doing. There's 4 columns on here, and we've divided columns into types of syndications and dollars amount raised. Let's go through the vocabulary first. A specific offering is we're going to buy the property on Main Street. You can put together an exhibit for the private placement memorandum that has pictures and demographics and rent roll and everything, but it's for that one specific property. So the smaller offerings are generally specific offerings. As the offering size gets larger, we might do specific properties. I should have put that word in there. But then we come into semi-specific. And this might be where we're going to raise enough money to buy one property we have identified. But while we're raising money, we're going to raise enough money to buy another property according to our investment summary, our business plan. Semi-specific. Or blind pools. This particular column is for our investors who raise between 2.5 and 5 million of equity. And we had 10 of those in the last 25 offerings. And some people are still flipping houses. Some people are making multiple loans on properties. Some people are buying blind pools of properties where they don't know what property they're going to buy at all to start with, but with $5 million in their marketplace, they think they could buy 2 or 3, and maybe they'd even have the right to expand their offering to buy more properties. And then 5 million or more. Generally, we get into large specific properties. At the end of 2022, we were doing offerings of 40, 50, 60 million dollars on apartment complexes where the syndicator had put together a fund to buy an apartment building in 2017, 2018. And by the time 2022 came along, that $15 million equity that they started with now was 30 million. And so they could do the fund could do an exchange into another building. And it might be a $60 million building where they put down $30 million. So it's amazing. The biggest one we've done was 165 million for a company who was going to do a blind pool and buy a medical office, surgical centers. And they raised all the money, if you can believe it, in 30 days. They hooked up with a couple of family offices who were interested in something like that. And that's a whole nother area that we could talk about individually. How do you deal with family offices? They have a lot of money to invest. So first of all, I want you to see that raising 5 million or less is where there's a lot of business and a lot of offerings going. And so you can do that. I don't want you to be frightened by the $2.7 trillion number. So the next thing we want to talk about, and my first 2 chapters of the book really dig into fiduciary duty and do you really even want to be a syndicator? And what I can talk about now is somewhere in your CCIM class, someone has drawn a picture, and I always used to draw it, about the real estate transaction cycle. And the real estate transaction cycle, if you're a tenant rep, you've got users and you're looking for properties to put those users into. If you're a lender, well, you're looking for investors who own properties and need to borrow some money. If you're a broker, you have a property listed. Well, you've got to help with lenders and you've got to find investors. So all this is matching. That's the real estate brokerage model. You're matching. You get an assignment. You sign a contract of some sort. You complete the assignment and you get paid and you're done. That's totally different than being a syndication professional, being a syndicator. You have to find the investors, you take their money, the money goes through you into the property, it stays there, it comes back out of the property through you back to the investors. In the real estate transaction cycle, you don't take any money from your clients. The money goes into an escrow account, it goes somewhere else. But in this business, you're running Investment LLC. And that's where the money goes. So you're in charge of all the money. Not that there isn't fiduciary duty over here in the real estate transaction world. Certainly there is. But this is the big place for fiduciary duty. The fiduciary duty that we'll talk about in the book deals with fraud and misrepresentation. And Jonathan is going to tell you that the securities law starts out as a criminal statute. And we have, in the last 4 or 5 years, seen a number of people that have hit the news that have gone to jail for their misdeeds in the securities world. And it's all about fiduciary duty. They're mishandling the money of the investors and they can go to jail. Now, there's a lot of actions which come way short of going to jail. But certainly there are fines, there are cease and desist orders, there are all sorts of things that can happen in the securities industry. And it all generally deals with your breaking your bond of fiduciary duty with the money that you have from investors. In short circuit, in fiduciary duty, you're supposed to manage the money of your investors as well or better than you would manage your own money. You owe it to them. And so that's something you'd read about in the first couple chapters of the book. Now, since we're doing a CCIM class, a class based in CCIMs, I want to show you, and I think I'm comfortable showing you a few T-bars. For 40 years, my world was T-bars, and I still use it. It's just the best vehicle to show people what's happening. And in this set of T-bars, which is different than anything you've seen, because this has a fourth T-bar in it. This has the syndicator, the sponsor's T-bar, and I'll get to that in a minute. But if you were to look at a property, and you could buy it yourself, you had all the cash you needed, you'd analyze the best price, you'd analyze the operations, and you'd come up with cash flow before taxes. Just as an aside, when we're doing syndication work, we're not doing after-tax analysis because investors have so many other investments, you have no idea of what the after-tax situation is. We'll talk about depreciation. We'll talk about early write-off, bonus depreciation, cost segregation. We'll describe it if it applies to the offering, but we won't tell the people how it's going to affect them. But we will give them, you will give them a projection of cash flow before tax from operations. And then at some optimum disposition time, you should have a disposition strategy. At some optimum disposition time, you'll make an assumption of what the sales proceeds before tax will be. And if you know the price, the cash flows, and the sales proceeds, and the time, you can do cash on cash, cap rate, IRR, financial management rate of return. You can do all that. But most of us don't have all the money we need to buy the property without some help, and we go over here and enlist the help of the lender. And for the most part, there's more debt in a transaction than there is equity. So this is an important T-bar. And we teach you in CCIM how to look at the loan and the upfront costs and what the annual debt service will be and what the payoff is. And so you can calculate the yield to the lender. So the property owner will have a price minus what the lender gives, and the property owner will put up some money. The property owner gets cash flow before tax, makes a debt service. The property owner gets a cash distribution on the sale. The property sells, we pay off the loan, and we get some cash. So the lender has an IRR. The property on itself has an IRR, and we can analyze the IRR for the investors. But that doesn't cut it in the syndication world because we're going to have a syndicator, and the syndicator is going to get paid. We've been through a list of fees and distribution sources. So the syndicator will structure a deal that they get paid fees, and they get paid, and or the syndicator gets paid percentages of the cash flow and the sales proceeds. Why this T-bar is important is this changes the cash distribution that's available to the investors, because this gets paid before the investors gets paid. So it's a cost. So one of the things you have to make an observation about is your property has to be good enough and produce enough revenue that it can handle the cost of a sponsor. Now, when I started, one of the mistakes I made is I knew that there was going to be this T-bar, but I had the two T-bars reversed in order. I had the investors and I had the sponsor. The sponsor was me. So I went and said, okay, what do I need to give the investors as a return so that I'm comfortable that I can go out and raise the money? Because as I started, just like everyone else, we're not so convinced we can raise money. So I had to figure out what would the investor need to make this deal work. And then I looked at my T-bar, which was over here, and said, well, what's left for me? And that turned out to be a mistake. So I moved my T-bar in here, and I say, okay, let's see, what would a sponsor need to take to make it worth their while to assume the risk of being a sponsor? And then if we get that right, what's left for the investors? Then we can make a decision. Are we going to do this deal or not? And if you're true to what the sponsor should get, you'll never say, well, let's just take a little bit from the investors, or let's take a little from the sponsor and give it to the investors so we can do the deal. You'll just pass on the deal. That's what you should do. Now, one of the things that we learned in CCIM is net present value. In this T-bar, I have sponsor risk as point of time zero. I don't have any dollars because you really, as a sponsor, as a syndicator, you don't pay to be the syndicator. It's true. One of the 4 questions the investors is going to ask you or should ask you, and you should ask if you're going to invest with someone else, is do you have any skin in the game? Are you putting any money in the deal? And in that case, the sponsor is going to invest just like the other investors do. He may not have to put in the same amount of money that the others do. The sponsors may be able to put in less. It just depends upon how the deal is structured. But there's no question that when an investor asks the syndicator, are you putting in any money? She's going to say, yes, not only am I signing the loan, but I'm going to invest some money. So since there's no dollar amount there, but there's dollar amounts here and there's dollar amounts here, and you want to figure out what is this T-bar worth, you put in an interest rate. You give it an interest rate and you solve for present value. And then that'll tell you what this set of T-bars, what this set of cash flows is worth to you today. And then you make a decision on whether in today's dollars, it's worth taking on the risk of this project. And now you're all thinking, well, what interest rate am I going to put in there, Gene? Ballpark, if it's a stabilized property, meaning that within the first 6 months, which is typical, we can start making cash distributions, and there's no great capital expenditures involved, I think 15% is a good number. Discount these cash flows at 15% and see what it's worth. If it's a non-stabilized, it's a development project, there's no cash flows coming for the first couple of years and it's full of development work, I think you might need to go to 25% for your discount rate. And then once you say, this is what I want, you go down and look at the investor's T-bar, and then you have to say, is this saleable? And today, just generally speaking, and it all depends on what product type you have, 4 to 6% distributable cash flow to the investors, cash on cash will sell. And on a pre-tax basis, if you give an investor between 10 and 15% on a stabilized property, that's saleable. If it's a value add property, you probably have to be between 20 and 25. So that's about what I can tell you on that T-bar. Okay, so there's a couple of questions I'm going to answer right now. What percentage does the sponsor have to put in for the investors to find that the deal is credible? That's a marketing question. There's no direct answer. But I will tell you that in the old days, I always measured it by the amount of cash we put in. And now I think you need to tell the people that you're signing the mortgage and you're putting them some cash. If in fact your minimum investment amount is $100,000 per investor, I wouldn't see you having to put in $100,000, because how many deals can you do if you're putting in $100,000 in every deal? 50,000 might work, 25 might work. It's all marketing. It's not driven by the securities laws and all. And will you provide the class this T-bar in Excel sheets? No, I don't have this T-bar in an Excel sheet, but And I'll tell you at the end of this, Jonathan will tell you on Friday. Gosh, I'm forgetting his name right now. Jeff Engelson out of the University of Denver has a ward center on Excel spreadsheets, splitting ownership, deal structuring on Excel spreadsheets. Jeff Engelstead at the Ward Center. And he goes through in his class a number of different setups, and he does give you the Excel sheets. So I don't have an Excel sheet for you on this. All right. Anything else, Jonathan, I need to cover right now?
Did you answer that question about the fee regarding refinance?
Oh, I didn't see that. What do we do? Usually 1%, right, Jonathan?
Yeah, 1% is pretty typical.
Pretty typical. The same as basically the same as the disposition fee, 1%. Okay, I'll go ahead. So we're back here. We're back here to our major picture. And I'm going to talk about this, and it's about time to turn this over to Jonathan. But what I want to talk about is using this picture to help you understand why this is a security. Remember, we said a member managed LLC. It's the members making all the decisions. All the decisions are unanimous. No one has a bigger vote than anyone else does. No one is in charge. That's important because in this picture, it's different. In this picture, we have all the members investing their money into the LLC. And they're probably doing it for a profit. This is not GoFundMe. This is a profit venture. We're going to buy a property. We're going to invest in a business, do a blind pool, and buy a number of properties. So there's a profit incentive expected by the members, but it's all going to be driven by the manager. Okay? The manager is going to be in charge. Now, the manager doesn't technically have your money, but the manager is in charge of this LLC where all the money is. And the operating agreement gives the manager to control the authority to control all the money. So if I put it in different words, it's an investment of money on behalf of all the members into a common enterprise. Whatever it is, everyone is doing investing in exactly the same thing with an expectation of profit driven by the third-party manager, driven by the sponsor, driven by someone else who's in charge of the money. So that's my picture of the securities law, the picture of something called an investment contract, which is a security. And with that, I'm going to turn it over to Jonathan.
Thanks, Gene. So kind of switching gears now for the rest of today and pretty much the most of Friday as well. We're going to be talking exclusively about securities laws. Very little of the rest of today and Friday is going to be about real estate. So getting into that, federal securities law. So this is federal law, and this is the area of law that Gene and I practice, right? So we are securities attorneys. When you are syndicating a deal, you're probably going to have to, depending on how you set it up, you're probably going to have 2 attorneys on the deal. So I think Gene mentioned before, you're probably going to have like a local real estate attorney that's going to handle, the LOI, the contract, PSA, dealing with the lender, dealing with closing, right? And that's because real estate law is state specific, right? So depending on where the property is that you're trying to acquire, you're going to need a local real estate attorney to handle that side of the transaction. Well, if you're syndicating the deal, you're also going to need a securities attorney like me and Gene to handle the money raising, to handle the securities side of it. So federal securities law, and it's important to point out that this is federal law. There are state specific securities laws, but in our practice, and you'll see in the real world, that federal law definitely dominates. And it, looking at public markets, it's kind of pretty evident why that is, right? So on the New York Stock Exchange, you have all these public companies, and they're most likely formed in Delaware, and they're selling investments to the public, to people all across the country. And because of that, federal law definitely applies. In the private markets, it's definitely possible to have a company that's selling securities exclusively in a single state. And if that's the case, so the state law would apply in that instance. But what we've seen in our practice is most people are crossing state lines. Most people are raising money from multiple people across the country. And if you're crossing state lines, then federal law applies. So that's the reason why, Gene and I, we practice federal securities laws. To kind of give you like a brief overview of federal securities laws, I find it helpful to kind of have a little bit of a history lesson. So prior to 1933, we actually did not have any federal securities laws on the books. There were no statutes governing the sale of securities. And if you remember from U.S. history class in high school, what was going on in the country in the 30s? Well, we had the Great Depression, we had FDR and his New Deal, a set of laws trying to get the country out of the Great Depression. And there were a couple of laws that were passed at this time to kind of also fix or prevent the country from going into another Great Depression as it relates to securities. And that's because in 1929, we had this great stock market crash that directly led to the Great Depression. So part of the New Deal was, the passage of these couple laws to make sure that we did not have another crazy market crash. And that was the Securities Act of 1933 and the Exchange Act of 34. And really, those are the two laws that all of our federal securities laws kind of come from. And still to this day, those are the two laws that we look to when we're, helping our clients set up their deals and raise money. But really, these two laws were designed to protect the public against two things, right? So Congress, when they wrote the laws, they took a look at the market crash of 29, and they kind of wanted to analyze what caused it, right? So one of the things they found was the fact that investors had no idea what they were buying, right? So the securities that investors were purchasing prior to 33, they didn't disclose or they weren't required to disclose any of the relevant information about the securities, right? So risks, the risks involved of what they're purchasing. So one way to fix it was, to provide full disclosure, the requirement that all of the material information about a security has to be disclosed to investors. And the theory behind that is, if investors are fully aware and fully disclosed, well, buyer beware, right? The investors, only have themselves to blame if they lose their money, right? So the markets will kind of adjust themselves, and there'll be, more truthfulness and more honesty in the markets, right? So that's the number one way that our securities laws protect the public, is through the requirement that everything be disclosed to investors. And the second way is by regulating the people involved. So again, Congress looked at the market crash of 29, and they saw all these people that were selling securities using fraudulent techniques or deceit or misrepresentation, right? So the second area that our laws kind of focus on is the people involved, making sure that there's regulations in place to prohibit those deceitful practices. And that's kind of really the Exchange Act of 34 is more about that, because the Exchange Act of 34, by its name, is, it governs exchanges, it governs broker dealers, it governs, the people involved selling investments. For our purposes, though, and for this class and for our practice, our main focus really is on the Act of 33. The Act of 33 governs more about the securities themselves, the investments themselves, issuers, companies that are selling securities. That's what an issuer is. I'm not sure if Gene mentioned earlier, but when we say offering, that's the offering of securities. So for this class, and if you go to the next slide, please, Gene. Gene, are you there? Oh. Oh, okay. Thanks, Gene. So for this class, we're just pretty much only going to talk about the Act of 33, the Exchange or the Securities Act of 1933. And this act is very, very important because, as Gene mentioned previously, it is a criminal statute, right? So I think a lot of people who are thinking about selling securities forget that there is criminal liability when you are selling securities. There's definitely more civil liability than there is criminal, right? So the SEC, the Securities Exchange Commission, is a civil enforcement division of the executive branch, right? So they have the ability to, levy fines against you, levy penalties, injunctions against you if you, are found to have violated the Securities Act of 33. But they also have the ability to refer you over to the DOJ, the Department of Justice, who is, they're the criminal side of the executive branch, and they can investigate issuers for violating criminal laws, right? So usually it involves something more than just making a mistake on your filing or something like that. There's probably some element of fraud involved if the SEC has to send you over to the DOJ. But it's definitely a risk that you have to be aware of if you are a syndicator or thinking about becoming a syndicator and selling securities, right? That there's this risk that you could be subject to criminal liability. The Act of 33 also define what a security is. So there's a definition section of the Act of 33, and in it says a security is, and then it lists off a bunch of terms that are by definition of securities. So shares in a corporation, stocks, bonds, convertible notes. There's a whole list of it listed out. And then at the end of the list is this term investment contract and other investment contracts. And it's kind of, a little ambiguous. What does that mean? What exactly is an investment contract? Or really, when does an investment contract rise to the level of a security? Because if you think about it, what's an investment contract? Is it any contract that involves investment of money? That could cover a giant wide range of things. And so the reason why the Act of 33 has this term here is because they knew that someone in the future would try to sell something that wasn't, one of those defined things or one of those things in that list of a security that was kind of like a security, but the only reason they did that was so that they wouldn't be governed by the Act of 33. So this is kind of like a catch-all term that Congress inserted in there to make sure that you can't get around this loophole. If you're selling something that looks like a security but isn't called a security, you're still governed by the Act of 33. And then finally, the Act of 33 established the basic rule, the general rule, that the sale of every security must be registered with the SEC unless exempt. So registration is essentially, when a company has an IPO, right? When a company does its initial public offering, they're registering their securities with the SEC for the first time. So, you can imagine, if you're selling securities, that's the process that you're supposed to go through. You're supposed to essentially do an IPO unless there's an exemption available to you. And that's what Gene and I, really what we do for our clients is finding that exemption, navigating them through those rules to make sure that they don't have to register their securities with the commission. Next slide, please, Gene. So, what is an investment contract, or really, when does an investment contract rise to the level of a security? Um, Again, it was a very, ambiguous term that they inserted into the law to kind of, make sure no one could take advantage of a loophole. And the law was passed in 33, and it was kind of unclear what Congress meant by this term investment contract for I think about 10 years or so. And anytime there's ambiguity in a term or ambiguity in a law, what happens is we need some sort of court case to resolve that ambiguity, right? So, um, um, so that's exactly what happened in this case, right? So, to kind of give you the facts of the case is called Howie, right? Because there's this company called Howie in Florida, and they came up with the scheme of selling installment contracts to investors for a piece of land in Florida that had a bunch of citrus trees, like just imagine a bunch of orange trees growing on it. And part of the scheme was Howie would take care of all of the work in growing the trees, in harvesting the oranges, in packaging all the oranges together with all the other investors' oranges. Howie would sell the oranges and then divvy up the profits back to the investors. Howie claimed, this didn't involve a security because investors were receiving an installment contract in the land. Well, somehow the SEC got wind of this scheme, and they sued Howie, saying that no, you were selling securities, and because you didn't register with us, you sold unregistered securities, and now we're gonna fine you and go after you for selling unregistered securities. Well, the case made its way up to the Supreme Court, and the Supreme Court decided against Howie. They decided in favor of the SEC, and they decided to create a test, basically, to determine when an investment contract becomes a security. And this is the same test that we use today, right? So Howie, I think, was decided in the 40s, and from 1940 something to today, this is the test that we use to analyze if an issuer is selling securities. So it's a 4-factor test. All 4 factors have to be met. So each one is essential, as an essential element of the test. And the test is an investment contract rises to the level of security if it involves investment of money in a common enterprise with the expectation of profit solely from the efforts of a promoter. So in Howie, the Supreme Court said, there definitely was an investment of money. Investors were sending cash to Howie. And further kind of court cases have clarified that it doesn't just have to be cash, right? So it's anything of monetary value. If investors are contributing property to the deal, that can be enough to meet this factor of the Howie test. Recently, right, the SEC has said cryptocurrencies or certain crypto coins and crypto funds can qualify as a security, even though it doesn't involve the actual sale or it doesn't involve actual money, because cryptocurrencies have monetary value, right? So that's the first factor. In a common enterprise basically means that there has to be a pooling of investor funds, or a pooling of investor resources, right? So in Howie, the Supreme Court said that, it didn't involve just a single investor. Howie was raising money from multiple investors and pooling all of their oranges together in this common enterprise, as a single goal, right? So, if you had a deal that just had a single investor and no one else was involved in the deal, then that part of the test might not be met, right? But some courts have said an investor pooling their money with the issuer, with the sponsor, can be enough, right? So even though you only have a single investor, if they're pooling their money with you, the syndicator, or the sponsor, that could be enough to meet the common enterprise test. But if it's just a single investor by themselves and no one else is doing the work, then that's likely not a security because there's no common enterprise. The third factor of the Howey test is I think, or rather, I think this one is pretty critical because it involves the mindset of the investor, right? The expectation of a profit. You have to look at what was the investor's intent into getting into this this deal, and if it was with the expectation of receiving a profit, then that part of the test is met. So with Howey, they looked at the investors and they said, these investors weren't going into the transaction to receive orange trees. They were going into it because they expected to make a return on their investment. But this is the factor that when you look at crowdfunding websites like Kickstarter or GoFundMe, Indiegogo, those websites don't involve the sale of security because there's no investors on those websites, right? People aren't going onto a Kickstarter campaign to expect a return on their investment. They're just pre-ordering a product on Kickstarter. GoFundMe is donation based, right? People are contributing to charity on GoFundMe. Indiegogo, same thing. People aren't going on those websites to receive a return on their investment. The fourth prong of the Howey test, solely from the efforts of promoter, I think is the critical element of the Howey test, and kind of the critical element of a security is the fact that it is passive in nature, right? So there's someone or a company that is making all the decisions on behalf of the investors. And in Howey, I think this is kind of what did them in, was the fact that Howey was doing all the work to grow the trees, to package all the oranges together, to sell the oranges, and then to send the profits back to the investors. It wasn't the investors doing the work. It was Howey. And when you're when you're thinking about your own deal, setting up your own deal, this I think is the critical element to determine whether or not your deal involves the sale of a security, is whether or not it is passive in nature. So that's the Howey test: investment of money in a common enterprise with the expectation of profits solely from the efforts of a promoter. And to kind of reiterate, so what is the I guess the questions or the thought process you have to go through if you are syndicating a deal, if you're putting together a deal? Are you selling a security? Well, depending on how you set it up, it could be yes, it could be, or it could be no, right? So there's two ways to set up an LLC, either as a member managed LLC or as a manager managed LLC. If you are setting up an LLC as member managed, what you're essentially doing is you're saying the LLC is managed by every single member of the LLC. Every single member has equal say in how the LLC is run. And if that's the case, well, the last prong of the Howey test wouldn't be met, right? Because there is no more solely through the efforts of a promoter. Yes, there's probably still investment of money in a common enterprise because investors are pooling their money together in an LLC, and expectation of profit is probably also met as well, because why are you entering into this deal if not to make a return on investment? But if it's member managed and every single member has a say in how the company is run, then the last prong of Howey is not met, and you are not selling securities, and you don't have to worry about the securities world. You don't have to worry about hiring a securities attorney. You could just proceed with your deal with a single attorney, with a single real estate attorney, and you're good. Well, what if you set up your LLC as manager managed? And why would you want to do that? Well, imagine you're doing a deal with 10 or 15 or maybe even more investors, and every single investor has a say in the deal. You're not going to be able to make any decisions, right? So you need to set it up as manager managed so that you, the sponsor, the syndicator, has control over the deal. You get to decide how the property is run. If that's the case, you're going to set up the LLC as manager managed, and you're going to be the manager of the LLC. And if that's the case, well, now all four factors of the Howey test are met, right? So there's going to be investment of money. There's going to be a common enterprise. Everyone's in this deal, for the same purpose for that property. Investors expect a profit, and you, the manager, are doing all of the work to realize that profit for your investors. So you are now in the securities world. You're selling securities to your investors. And now, if you remember, the basic rule that the Act of 33 says is you are supposed to register your securities unless you have an exemption. So registration is essentially what we got in the black box on the right. So large public offerings, IPOs, or small public offerings under Regulation A, unless exempt. There's basically only a few exemptions that are available to you. A few exemptions that actually make sense economically for our clients to use, and those are on the left under intrastate offerings under Rule 147 and Regulation D. So I kind of briefly mentioned large public offerings, doing an IPO. I think it's pretty self-explanatory why you wouldn't want to do one if you're a syndicator, right? So imagine, or think about the type of companies that do large public offerings, right? So they're huge companies, with giant pockets. They're willing to spend a lot of money to go public, and that's because going public costs a lot of money, right? So you need to hire attorneys, you need to hire accountants, you need to hire underwriters. There's a lot of people you have to hire to go public, and a lot of money you have to spend to go public. And on top of that, it's a very, very long process to go public. I mean, it could take years to get approved by the SEC before you can, do your IPO. So if you're a syndicator trying to do, specific offering, a specific deal, you don't have, a year or 2 years to become public before you could, start raising money. And maybe you don't have, millions of dollars to go through that process as well. So that's why, none of our clients are doing large public offerings. Yes, Gene.
I want to address two questions that are in the the chat right now. The first question is, can you pay the cost of an attorney through investor funds? And the answer is yes. Most attorneys require payment up front, but then the offering documents are set up that the sponsor, the syndicator, gets reimbursed for all the expenses that they incur ahead of time to get the offering set up. So yes, the investors will pay for that. And another question is, how do you become exempt? Well, Jonathan's going to talk to you about becoming exempt in the yellow section of the slide. And the last question is, what if it's a sub-S corporation? And we never addressed that, Jonathan, but that's important. That's why I stopped you right here. The security law doesn't care what IRS set of rules you're using. You see, a sub-S corporation or a REIT or a limited partnership or a general partnership, all those things are entity structures that are driven by the IRS for certain tax outcomes. None of that matters to the SEC. It could be a joint venture, be a security. Anything that you put together can be a security, no matter what the structure is. And it doesn't just apply to real estate; it applies to businesses, it applies to cryptocurrency, it applies to everything. So those were the questions I wanted to answer before you went on to talk about regulation and all that. Okay.
So I think I'm going to talk about Reg A on Friday.
Oh, so well, then we answered the question ahead of time. Good. But But anyhow, that's where we are. And then someone else said, hey, there's only 25 minutes left and there's 35 slides. Well, this is a 2-day course and we're just about through with the day, and there'll be a bunch of slides for tomorrow. So don't worry about us running out of time. We've got plenty of time.
Yeah, if anything, we finished early today, Gene.
But we won't.
Well, I don't really have much else to talk about, so
Okay, well, let's do this and then we'll have some more questions. So then we're going to go to the next session, which once again is on Friday, same time, and we'll talk about more about securities laws. One of the things that we could do is we could recommend to you to go through the PDF of the book, and if you have time to read chapter 5, get an overview. That's what changes every time there's a new edition of the book, because it's all driven by the SEC. And we're going to talk about what's in a PPM, mistakes that sponsors makes, and steps for you to get started. But let's just stick here for a second. Large public offerings, right? When the 33 Act came out, they were interested in all offerings. There's no question about it. Then over time, the law changed. Somewhere along the line, I don't even remember when the first Regulation A came out, because no one used Regulation A until, and there's many reasons for that, until the Jobs Act came. But even prior to that, the government decided that there was going to be a marketplace for private placements. And 79, 80, and 81 was the 3-year time that Regulation D was suggested, was commented on, and became a thing. And Regulation D, which Jonathan is going to talk about on Friday, where we do almost all of our work, Regulation D is where we get offerings. We get an exemption, what's it called? When it's a safe harbor rule. If you follow Regulation D, your offerings will be exempt from registration with the SEC. And then there's also the interest rate rule that Jonathan will talk about on Friday a little bit, because Jonathan said earlier, states have their own rules. And so if you're doing a rule that's just inside a state and there's no crossing over state lines, you can do that. So this whole area over here is where we're going to do most of the business. But it is important that we have small public offerings and Regulation A discussion. And even though this slide doesn't say, I wonder, Jonathan, if you might want to talk a little bit about crowdfunding regulation crowdfunding on Friday, because we do have slides on regulation crowdfunding. So that'll be important, because there's a vocabulary issue of the word crowdfunding, right? So that's that. So we only have 2 minutes left. So let's see what other questions we have. This question is, can you look at the questions? I'm having trouble with my eyes. I had cataract surgery yesterday, and now I'm having trouble reading small things. Do you discuss the what?
The 83B doc submission to the SEC.
Well, that probably isn't part of a private placement, is it?
I've never heard of that. So
no, the only document we provide to the SEC is a Form D. which comes out of Regulation D. That's the only document we do in a private place. That doesn't mean it isn't something maybe we should look up, but what else? You'll have to answer these questions. I just simply can't read them today.
Is there some common fine print language I can put in all my marketing to follow Reg D or avoid SEC compliance?
We'll do that. That'll be in the PPM. Okay. And I think that in your marketing, the way, at least the way we do it, we put it in exhibit 4, which is your property package, your investment summary. And there's probably a disclaimer on the front of that. And you hear the disclaimers all the time when you listen to the radio. Grant Cardone is on there and he's talking about his offering. And then he says it's only for accredited investors and you get all your information from the PPM, not from this. So we direct everyone there. What about section 506D? I think we'll cover that. Jonathan will cover that when we get into that. Because he's going to give us all the rules that are in Regulation D. Is there anything else we missed on these questions?
I got a direct message saying, can someone be a syndicator with no credit and no money?
I did it way back then, sure. That's a marketing question. You know, your first deal, you're going to raise money from people that you know you. Let's say you're a real estate broker and you're doing some good business and people know what you're doing and they're kind of following you. And then you come out and say, hey, I found a property. Maybe we should all go together and buy that. Well, sure, that's marketing. The 4 questions that investors are going to ask you, we cover this now, cover it later, is number 1, let's say Jonathan's a syndicator. The most important question is Jonathan, if I give you my $50,000, what happens if something happens to you? So we have to cover continuity. That will help you if you yourself don't have money and credit. So find yourself a partner. Okay, that's a solution. And you'll find that on Friday. That's our number 1 step in doing this is finding a partner to do it with. Number 2, the question is, have you done it before? Well, we all had to answer no on our first deal, but we all must have had something that would convince some investors to invest with us. What's our business practice? What do we do in business? What's our education? Number 3, do you have skin in the game? Well, I'm going to sign the note. Now, maybe that won't be enough. Maybe I'm going to have to bring some enhancers in the deal. We can do that. And then the last question is there a liquidity provision for the investor in case something happens to the investor so they can get their money back? I didn't like this question so much. I understand it. I probably would have written that question myself with the same language in the past, which talks about fine print. We're not real big on fine print, are we? And I'm making a joke about that. But the first issue of the 33 Act is, do the investors have all the pertinent information ahead of time so they can make an informed decision? Well, I guess if you write your entire documents in 8-point, everything's fine print, but we usually write ours in 11 or 12, so there isn't any real fine print. I think that would be a mistake, and I'm only teasing whoever wrote that question. So I'm going to say goodbye. No, let Jonathan, you say goodbye first.
Okay, goodbye everyone. See you guys on Friday.
Okay, Jonathan will be with you on Friday. I won't be with you on Friday, but Jonathan and Derek from the Institute and Carrie will be with you and get started at the same time, same place. You have all the slides. I guess there was a question about how to get the book. I know we covered that on Friday, but our website, which is TNLLP, www.tnllp.com, stands for Trowbridge Nay LLP. has a place where you can order the book and just pay for shipping. If you want to do that, that's how you do that. All right, so thanks very much. Great turnout. We have 43 people on at the height today, and we'll see you all on Friday. Bye.